Thank you, Honorable Governor, captains of industry, and distinguished colleagues. I stand forewarned, listening to Diane, that this is not going to be an academic presentation. People are looking for solutions here, so I'll be very light on the details of research, so that we have more time to speak to the aspects that have a policy dimension and that have a market dimension to the research that I'm going to present. And I think the paper that I'm going to present, I think is available somewhere. So for those that are inclined to look at the methodology and see whether they are somewhere or we tripped, they can be able to do that. But I'll just probably give a highlight of the process, so that at least there's comfort that we went through a scientific process to come to the findings. The third general thing I'm going to say is that the paper is presented in a manner that the subsequent presentations layer themselves on the aspect that I've been mentioning. So essentially, it will be a platform around which the other papers will be presented. So the optimal credit path for Rwanda. This is a very interesting subject, at least to me, because the one aspect of credit and growth generally is that this is an area that has been researched from very many dimensions. The debate around how credit markets support economic development is an old debate, but it's one debate that has never gone away. It's revisited from time to time. And some of the references that we make in this paper include research that have been done in Rwanda here, some of which have been published as late as last year. So that means, therefore, that there are a number of things that we know on the credit growth path, not just for Rwanda, but from elsewhere, but also a number of things that we don't know. And that is really why we thought that this would be a good platform for purposes of this research. Now, what I'll do in few minutes is provide some context as to why we think that it's important to understand the optimal credit growth path for Rwanda. And then I'll go into what we call stylized facts about the path around which credit has grown in Rwanda. And we do so that we're able to highlight some of the things that may look to be fairly obvious, but with a lot of hidden meanings insofar as the credit market is concerned. And then from there, I'll be able to give the empirical findings. And then from there, I can be able to infer some conclusions with a policy dimension to it. Now, let's step back and ask ourselves the question as to what extent has financial depth been an engine to economic growth. Over the past 50 years, this area has really attracted researchers in the respect of understanding not just how finance supports economic growth and economic development, but what are some of the underlying dynamics that can make finance be not just an engine of growth, but potentially cause issues insofar as economic progress is concerned. And if you look at over the period, there have been a number of regimes insofar as the analysis of credit as an engine of growth is concerned. The big regime shift was the behavior and understanding of credit as a driver of growth before the global financial crisis and the period post the financial crisis. And that divide is actually interesting because previously there was an assumption that finance is a servant of the economy. And subsequently, commentators have talked about finance now being a master of the economy, meaning that finance can influence the extent to which the economy evolves. Now, in the case of Rwanda, there was a paper that was done and published last year by Karekezi and others, which speak to the extent to which finance actually supports economic growth in Uganda. And there's another paper related to it that actually is a bit more innovative, talking about how there's a two-way relationship in the sense that as you see credit markets growing, they support economic development. But as economic development also grows, it actually fits back into how finance develops. So there's essentially what you can call a feedback loop between how finance supports economic growth and how that economic growth itself fits back into the way the financial ecosystem evolves over time. But underlying that, and I think this came out from the thoughts from the governor, there are some complexities that lie in there that require a very keen eye of the regulator insofar as enabling finance grow in a manner that is safe, because growth on itself can come with some endogenous dynamics that can actually lead to volatility. And that is more so when we start having financial innovation resulting in fragility in the financial ecosystem. And I think the research that has been done, especially around the understanding what happened during the global financial crisis, was around how innovation resulted into financial fragility. That does not say that innovation is necessarily bad, but innovation needs to be done in a safe way, and I think some of the papers that are going to be presented subsequently speak to this topic in a much more finer way. And the third, which may appear to be a bit controversial, are a number of studies that are actually coming up saying that finance has a limit beyond which it starts becoming detrimental to the economy. And from the review of literature, the estimates indicate that when you start having a credit as a share of your GDP going beyond 100%, then it comes with what you can call vanishing effects. The comfort you will take in this room is that if you look at Rwanda, the share of credit to GDP is well below that scope. That means, therefore, that there's appetite for the economy to push the credit before you can even start thinking about how that level will start affecting the stability of the economy. The message, therefore, in terms of context, is there is room for credit to grow substantially in Rwanda and therefore support economic growth without necessarily jeopardizing the stability of the financial ecosystem, bearing in mind that the regulatory space is also evolving over time to make sure that growth is on a safe path. Now, why optimal? We talk about optimality in the sense that you have to look for a balance between credit growing in a manner that maximizes economic benefits, while at the same time not jeopardizing financial stability. That's how you define optimality. Now, there are a number of things that you may need to see that underlying the determination of the optimal path for the case of Rwanda. The first is what we call just appreciating how the path of growth has been over time. And there was a reference again by the governor about how growth over the last 10 years has been astronomical. And I think you can see that obviously in terms of how the banking assets have been growing over the last 10 years. You could see a gentle rise over time, but over the past 10 years, you can see a very rapid growth of the banking industry total assets as a share of GDP. That tells you, therefore, that the market has been growing in a manner that actually supports economic activity. But the other thing you can see from these two regime kind of credit growth path is the fact that credit in the Rwandan market is substantially by the banking industry. If you look at that chart, which has an orange line and a blue bar, the blue bars basically tell you that you're looking at the domestic credit share by the banking industry. And the other one is the total. And when you see them overlapping, it simply tells you that it's essentially the banks that are driving the credit to the domestic economy. And therefore, what happens in the domestic banking ecosystem is really going to be the engine of how the credit is going to be the driver of growth going forward. And some of the inferences we'll be making going forward will be to what extent are you going to move the market beyond being substantially bank-driven, because if it's only solely bank-driven, then that extent of concentration in one segment of the financial ecosystem has its own limitations, and therefore bringing out questions that researchers need to ask themselves about whether the growth path is necessarily optimal if it's leaning substantially to one segment of the financial ecosystem. So this is one set of stylized facts that we look at, but we don't really appreciate what's underlying them. The second is, to what extent is that path deviating from what you can call its long-run trend? And here there are also two regimes. You could see, as if it's a normal oscillation around the long-run trend. But the reality is that, when the credit to the private sector in Rwanda was growing at a very slow pace, its deviation from the trend was a bit more volatile. But as it started peaking, especially over the last 10 years, those oscillations become a bit more smoother. That therefore tells you that we have reached a point where the deviations reflect the extent to which the markets are adjusting to what you can call its long-run path, and therefore start inviting thoughts as to whether are we really on an optimal path. So that is also another thing that may not be very obvious when you just look at the numbers without really looking at what underlies them. And underlying that is the fact that when you start seeing credit growing very rapidly, you have to ask yourself, is that the point at which you start seeing a very strong relationship between credit and economic growth? And the answer is simply yes. Initially, yes, credit was growing, but at a very slow pace. But when you started seeing it growing rapidly, it started aligning itself more closely to the way the economy grows. So that's really the context around which we start looking at the optimal path of credit growth in Rwanda over the past, say, 20 years. And especially that being a platform to seeing how credit now will start being even a bigger driver now that technology is coming into play. And technology comes into play at two levels. The first level is that it brings in a new way of product delivery. And secondly, it also brings in a new level of market competition. Market competition in the sense that we have an emergence of new players that were never there previously. And secondly, an emergence of new way of doing things, even amongst those players that have been existing over time. So those set of stylized facts then lead us into what you can call the relationship between the credit growth and financial stability. And here we are talking about if credit is growing at a very rapid pace, does that necessarily mean that you have a deterioration of asset quality as that growth happens? Fortunately for Rwanda, we actually have the reverse of that, where you're seeing credit growing, the market growing, but the asset quality, as could be revealed in the level of non-performing loans, has been on the decline. Of course, you can say that that's a very good, comfortable space to be in. But I have other thoughts around whether you want to drive your NPLs into zero and therefore say that you're completely safe, because that will essentially mean that you're not taking risks and supporting the economy. And therefore, if you see you're growing at a path, that is underlying that path is a very low level of NPLs, then I think we may start asking ourselves some questions. But what this tells you is that we have a situation where you start seeing the level of non-performing loans as the credit grows tipping up. And by our estimation, when your credit growth as a share of GDP starts going towards 25%, you start seeing the corner turning. But the argument we make in this paper is that at that point of turning, you're still very, very, very far insofar as the threshold that can make you optimize the benefits out of credit growth to the economy is still very low. And that's another point that I think we'll be emphasizing as we make policy inference out of this. So this is, I'm not going to talk about the modeling aspect of it. I'll basically go straight into what we call the core findings. When you look at how credit interacts with the broader economy and how that reveals having asset quality, one thing becomes obvious. That relationship is not straightforward. It's nonlinear. And it's nonlinear in a manner that reflects that at some point you start seeing the levels of non-performing loans, if that's your measure of instability, starting to turn gradually. Essentially, you have what you can call a U-shaped relationship. Initially, when you have a gap between your optimal path, your optimal level of the trend and the actual growth increasing, then you start seeing that resulting in the asset quality behaving in a certain manner. But beyond that, you start seeing a threshold emerging, and that threshold, according to our estimation, is around 22% of credit as share of GDP. That tells you, therefore, that if you want to start appreciating whether you're on the optimal path, the question you have to ask yourself is that, is really that level where you want to be? Do you want to be in a situation where below 30% of your GDP, you're comfortable because your asset levels appear to be, less threatening insofar as stability is concerned? The second thing that you probably need to see there is that maybe at the level of the depth of the financial ecosystem that you have in Rwanda, there's a feeling that the extent to which the market players themselves want to assert their market reach is characterized by two dimensions. An element of caution, because, the shareholders may be asking questions about, a return, but behind that return, they don't want to have a situation where the quality of assets become a cost to themselves. And therefore, implying that, the thresholds that we are establishing here are necessarily going to be a trigger for us to think of what impetus need to be put in the economy in terms of the structure of the financial ecosystem to push the market to a higher level so that the benefits of economic growth arising from that growth path of credit are enhanced as a result of a safer financial ecosystem. Now, this is really a slide that I wanted to spend a bit more time on. And this is really how you're seeing credit evolving over time, and the message there is that if you look at the top chart there, we are talking about the loan to deposit ratio. One could say there's a crude measure of market liquidity. That if you have the loan to deposit ratio very high, simply means that you're converting your deposits as a banking industry, because we have already said that the banking industry is really the engine of credit. If it starts coming down, then it means you're leaning more towards being more liquid than being more profitable. Essentially meaning that you're preferring to be liquid than giving more credit to the market. And that happens on the backdrop of your levels of provisioning coming down, meaning that if you are providing adequately within the guidelines that you're given by the regulatory agencies, and you're seeing that trend of provisions coming down, then it simply means that your asset quality is actually very good. But if that asset quality is very good and your non-performing loans are below 5%, then obviously you can argue that even if the credit that you're providing to the private sector is on a growth path and the banking industry is growing astronomically, there are trade-offs in there. And the biggest trade-off is that banks may not be taking sufficient risk as could be revealed in perhaps the level of non-performing loans. There are some studies that have empirically confirmed, and they're not necessarily in the context of Rwanda, that so long as your non-performing loans are within single-digit level, but so long as that single-digit level is not below 5%, that level cannot result in instability of the financial ecosystem. And if I can take the wisdom of a poet called Stevie Smith, who did a poem in 1957, where you see somebody in a swimming pool with a hand up, and the question is that person waving or drowning? The point here is that, liquidity is good, but too much liquidity may not necessarily be a good thing if that liquidity is revealed in your level of loan to deposits being on a downward trend. So that therefore means that we argue, and the paper argues that yes, we have a growth path in the credit, but for that to be optimal, it has to make an upward shift. But how is that upward shift going to happen? It's going to happen by two things. One of them is really to look at to what extent will technology be an enabler for faster growth of credit in a manner that does not necessarily result in instability. But that's just one aspect. The second is the nature of credit itself. If the banking industry is going to be the predominant provider of credit, then the tenor of that credit will be restricted by the way the banks fund much of the assets. If you're funding your assets by deposits, then the ability of you to provide a credit that is of a longer-term nature is likely to be compromised in the process. And therefore, the interplay between what the banks will be able to do and what capital markets are able to do is something that is going to be an issue that will be discussed as one of the ways of unlocking the potential. So it's not just technology, but the nature of credit that's provided in terms of what tenor are you able to provide. The third is that you have to start looking at the allocation of credit itself. Is it going to segments of the economy that are major driver? And I think we have a paper that is going to speak around credit to SMEs and what kind of credit to the SMEs is going to be appropriate. Now, there's obvious a question that researchers ask themselves that, yes, SMEs are constrained by credit, but is that the only binding constraint? Because SMEs actually could be constrained more by access to credit than the cost of credit initially, but as they grow and emerge to be bigger, then the cost of credit becomes an issue. And the final point I'll make is that when you talk about embedding capital market operations, whereby the banks that are predominant credit providers are probably issuing things like longer-term notes, that does not mean that you have what you can call a zero-sum game between what happens in the capital market space and what's happening in the banking space. What I've seen in some markets that you have an element of co-evolution, where actually the banks themselves can be the driver of what happens in the capital markets. And I think Rwanda set a good example in what has happened, for instance, in the issues of what they're called sustainability-linked bonds. I mean, if that becomes a norm in terms of banks coming to the market and issuing such kind of products, then we'll start seeing credit growing and shifting from where it is. So essentially, this paper is simply providing a challenge to the banking industry to push the accelerator so that, this, what the governor referred to as astronomical growth may appear to be necessary but not sufficient if the economy has to benefit from a growing credit space. So I've avoided making this academic, as I was invited to do, so that I'm able to at least provoke a conversation around the dimensions of the credit market that will make the path actually optimal. So the simple message that I've been shying away from saying is that, yes, we are growing, but that is suboptimal. The economy can actually do more with an enhanced credit growth path in the context of what we are seeing from the numbers. That is the first presentation, and I'll be more than happy to take your questions. Thank you.
We have some minutes to get questions and contributions from the floor.
Thank you. It was a really great presentation. I wanted to ask about the benefits of using market-based systems versus bank-based markets. Do you think that public blockchains would be able to enhance the diversity and liquidity of markets versus bank-based markets?
Okay, so I'll take that, or I'll take others.
Since we have another hand, let's take the two questions and then you'll respond to both of them.
Thank you very much. I'm John Bosco Kalisa. I'm the Vice Chair of the Rwanda Council of SMEs. First of all, allow me to congratulate the Rwanda Bankers Association for this insightful conference, looking at the credit market dynamics and the regulation. But also allow me to congratulate our new governor for the appointment, but also for your knowledge about the private sector and the Vice Chair of the Bankers Association. The research is very good, and I've been working across the region. Rwanda is doing well in terms of the credit to the private sector. It is growing, and I looked at the number 25. I think it is the best within the region, 25% being extended to the region. My question about the credit and the banking sector is the risk-averse aspect, which you didn't mention. The banks are trying to immunize themselves from risks. That's why you said NPL is less than 5%. But you didn't look at the aspect of the private sector. Currently, when you look at the numbers, again, I'm from SMEs, the numbers, SMEs that are accessing the traditional credit is less than 20%. And looking at the recent report by the World Bank, 97% of Rwandan business are SMEs. And when you look at your modeling, you are only looking at the 2% accessing that credit, and that growth is reignited or engineered by the big companies. So we want to look at that aspect of the SMEs. How do we, and I was expecting even from the research, what are the baseline are we using? That growth should be based from last year or from 5 years. Currently, where are we in terms of extending credit to the private sector? Are we waving or droning? Are we moving in the right direction? So we need that kind of a discussion and a paradigm shift in our discussion. And I want to thank Diane, the CEO of Becca, recently invited us. He trained our members, and he has created a department, a special department for SMEs, looking at those hurdles that SMEs are grappling with, and how can Bank of Kigali really extend the reach to the SMEs. This is happening from Bank of Kigali, and I saw also I&M is coming on board, and I encourage other banks. I saw we have 12 banks now. I encourage other banks also to establish a special unit for SMEs. Thank you very much.
Okay, so let me just start address those two questions. The first one is the dichotomy between market-based and bank-based financial systems. That contrast is not stark in the sense that there usually overlaps between them. If you look at markets that are predominantly bank-based, there's an element of capital markets that come into play. And those that are, you can say, having a significant market-based, they also have very strong banking ecosystem. The fundamental difference that exists between the two is when the systems are subjected to a shock. The way in which they respond to shocks differ depending on whether you're bank-based or you're market-based. And the good evidence we have is during the global financial crisis. The Asian markets were usually leaning more towards being bank-based, and the Western markets were more on the market-based, meaning the capital market side of things were the ones that were driving the economies. But how those two market systems relate to economic progress, there's no difference. So it's how they respond to shocks. That's one point I want to make. The second point I want to make is that there is what you can call a coevolution, and that is a point I made implicitly in my presentation. The two should not be seen as one vis-a-vis the other. The two actually co-evolve. I can give you an example. When you look at within the East African, we don't have very deep capital markets. But when you look at the Kenyan market, for instance, where we have a slightly bigger, a capital market, the biggest players within that space of capital market are banks. They are the ones that are mainly listed in the Securities Exchange. But beyond being listed, they are the ones that are now playing within the investment banking space, which supports the capital markets growth. So don't look at those as a stark contrast and one that are competing amongst each other. So that is really the advice I can give when you're looking at market-based vis-a-vis bank-based. When it comes to SME, I couldn't agree more. I think the SMEs are really a big player in the Rwandan market. And as I said, we are going to have a paper that is going to zoom in on SMEs from the context of how the SMEs can benefit out of the dynamics that are happening in the market. From the conclusion of our paper, we actually say that there's a huge scope for SMEs to benefit from the credit that is available in the market. You made an observation about banks being risk averse. I could use slightly different words. I'll say that banks actually managing their risks in a way that fits within the regulatory framework that they operate in. That means that no, they are taking risks that allow them to operate in a manner that doesn't jeopardize the stability of the financial ecosystem. The only challenge we have thrown in the paper is that no, they can actually push more so that, as I said, when you're seeing the waving the ant, they're basically not drowning, but they're waving. And that's really the point you can take from here. But rest assured, you're going to see a paper being presented that is having a razor focus on the SMEs and how they play within the credit ecosystem. We're done? Thank you.